Yeah, and I kind of touched on this in in the previous question. How it affects the sizing is, for example, if you're investing for Mrs. Jones, who's 90 years old, right? And you're investing in a senior position that's paying her X amount of income. If that sponsor has moved that position or moved the money down into a special purpose entity and is now using it for equity, and there's an enormous amount of layered debt on there, now the whole risk profile of what you thought Mrs. Jones was getting, for example, has now changed. And it's not necessarily a bad thing if you understand that, but if you don't understand that, and Mrs. Jones, who's 90 in this example, if you don't understand that and Mrs. Jones isn't suitable for that type of investment, then you have to ask yourself, well, wait a minute, this has significantly impacted it. And if you happen to get questioned by a regulator or your broker-dealer, they're saying, wait a minute, this doesn't suit Mrs. Jones or Mrs. Smith, right?
Well, I think the main thing is just to understand where you're at in the capital stack and ensure that your client has a high likelihood of receiving the return that's associated with where your dollars are placed. So if it's senior secured debt, that's a 4 to 6%. If it's development common equity, that should be around 20 or better.
As you're going through the capital stack with an investor, you want to determine where in the stack best fits for them. So if you're with an older investor, you want something that's more secure. They're looking for revenue, they're looking for income. They're not necessarily looking to knock a home run. A younger person, you're going to be more on the equity side. You may have a smaller investment size in the equity, but you have the opportunity for it to run at a much faster pace. So depending on where you are would depend on the age of your investor and their risk profile. You have some older investors that say, hey, we got a lot of money, we're willing to take a lot of risk. Or we don't have much money, we're going to take a lot of risk to try to get to where we want to be. And you have to kind of work around them. The question becomes, as an advisor or a rep, if they're making a decision on sizing that is possibly not appropriate for their age bracket or their current liquidity issues, then you may have to tell them no, and that becomes an issue for the rep and or the advisor as far as the broker-dealer. If you don't, something goes wrong, then you're dealing with a regulator and you're wishing you'd turn that trade away. So it can be challenging.
Capital stack manipulation has become an increasing problem in the market because of the opaqueness. You don't really understand what the risk factors are associated with a portfolio allocation solution. And that's because what we're seeing is the labels such as senior, mezzanine, and junior have become meaningless. Everybody kind of stretches the meaning of those terms to the point where they no longer convey the appropriate amount of risk and the appropriate amount of reward. I think of capital stack from the top. So one can either be at the top of a capital stack or not, and it's a binary yes-no question. If there is a complicated essay answer to the question, it probably means they're not at the top of the capital stack. It also occurs across 3 different locations. You can be at the top of a capital stack of a fund, in which case there's leverage at the top of the capital stack. You can be at the top of the capital stack of a company, or you can be a participant in a loan. And in order to really understand the type of risk that's associated with the investment, one has to understand at all 3 levels what the potential risks are and the potential rewards are.